An early look at what we should be expecting from our market today with Stan Shamu over at IG in Melbourne. Stan, another record high for the Dow overnight. Can you believe it? And how's that going to translate to 10 a.m. today?
Morning, yeah, absolutely. It does seem to still surprise a lot of investors out there, but of course it's only a marginal gain that we saw in US markets. Of course, this was triggered by those strong retail sales numbers coming in at a 5-month high, with retail sales up 1% as opposed to a general consensus of about 0.5% in the market there. But of course, the effect this has had has been to push the US dollar up. Now, whether this is positive for markets in general is obviously doubtful, particularly for a market like Australia, where we're heavily resource weighted, and of course, with commodities slipping due to the strong US dollar, it really does have a bit of a negative impact on our market. So far, we are calling the Aussie market up about 0.2%, so there's nothing much in it. Maybe we might trade just at about that 5100 level, which we fell below yesterday, but of course, with some of the major resource names likely to come under pressure, then it really does cast doubt on whether or not we can hold on to these early gains. We're currently calling BHP down 0.8% to 35.57. Of course, we did see iron ore slip around 3%. And that's quite alarming for the entire iron ore space. This will probably see these names come under significant pressure at the open. We also have gold retreating sharply, of course, with QE seemingly under threat from rapidly improving US economic data. It certainly seems like gold's not quite as attractive as it seemed a few months ago. So at the moment, it certainly seems the resources will get off to a very soft start. Whether or not this will be sort of nullified by gains elsewhere is still obviously very debatable. We already saw some of the yield plays yesterday coming under significant pressure. We had the likes of Commonwealth Bank and NAB retreating quite sharply, and of course Commonwealth has been at those all-time highs that everyone's been eyeing for a while now, but NAB couldn't even hold on to its gains even after announcing a major cost initiative over the next 5 years or so. So that just generally seems like we might continue to see some profit taking in the banks as a lot of traders and investors cover some of the losses they're making in the resource names, which have just failed to sort of fire over the past few weeks. This might cause an overall negative effect on the market, but we can't forget that the main reason that people have been buying into these banks has been as that quasi-bond play. So this makes the unemployment figures at 11:30 even more important, because we'll probably see a bit of a repricing on rate cut expectations should they massively vary from expectations. And should this happen, then this might have an impact on how the banks trade as well. Of course, with most of these banks yielding around 5% now, as opposed to the 9% they were yielding when their share prices were much lower, then it starts to come into question whether or not it's worthwhile holding on to these banks when they now start to seem very expensive. At the same time, we've got Maya's first half results today. There will be a strong focus on the sales momentum of the retailer. Of course, we need to see whether or not these big rate cuts from the RBA recently would have filtered through and have a positive impact on Maya going forward. Of course, they are one of the major retailers locally, so we always need to monitor them and see what sort of impact they can have on the rest of the retail space. Yeah, but apart from that, it's all about the resource names today, and whether or not the banks and the other yield plays can gain enough to nullify the losses that we'll see in the resource names.
Stan, we've seen the Kiwi dollar fall about 1% on the back of that statement and the decision to keep the cash rate steady. Not only that, but they're also telling us the overnight cash rate isn't likely to change for the remainder of the year. Is that uncommon for the central bank over there to make that kind of prediction or forecast? We just certainly don't see the RBA making those kind of calls.
Yeah, most central bankers are generally very good poker players. They normally keep their cards very close to them. but it certainly seems that they're quite happy with the market knowing what their intentions are. Whether or not this is positive going forward is always debatable, but of course we can't ignore that the challenges that the economy is facing over there, particularly with this drought that's supposedly threatening the economy. At the same time, they're quite concerned about the strength of the New Zealand dollar itself. So maybe it's a bit of jawboning. Of course, we've heard something like this from the likes of Japan recently, where they just continuously bombard the market with a negative rhetoric about their currency and try and depreciate it. So maybe this might be a similar tactic, who knows? But for now, what we do know is we have seen a massive fall in the New Zealand dollar versus the US dollar, dropping from around that 82.7 to around 81.7. It's been a sharp drop, and we'll probably continue to see more traders on the selling side rather than on the buying side. No one really wants to try and catch a falling knife at the moment. So yeah, no, that's definitely one of the trades of the day to look out for. Of course, we will have a few more comments from the Reserve Bank of New Zealand a bit later today, and this might have a bit of an impact on how it trades for the rest of the session.
Okay, Stan Shamu, thanks so much for chatting with us today. Appreciate it. Stan joining us live from Melbourne there. Well, in some more news out of New Zealand, Rio Tinto says it might sell its iron sands assets. It's under